Welcome back, everyone. Thanks for joining. On today's episode, we're going to be talking about how oil prices are killing the market. That's right. Gas prices are killing the stock market. My portfolio is down nearly 3% today. That's $10,000, and it's getting close to entering back in the red. And that is because overall the entire market is down today. Every single company is selling off. And this again is mostly due to oil prices. Gasoline prices are rising every single day, and there's many economists predicting that if gas continues to go up, we are headed for a recession. One of them says, quote, if we get $5.50 or $6, that would be consistent with $150 a barrel of oil. I think then we're done. We're in a recession. Right now, as of today, the national average of gas prices is $4.98. This is the highest it's ever been in our nation's history. With oil prices going to record highs, the 2-year Treasury rate surged to the highest level seen since 2008. These are meaningful moves in the small amount of time. This is risk-free money, so the more this moves up, the more stock prices move down. The overall inflation report is at 8.6%. It was expected to be 8.3%, so it's actually re-accelerating. And if we look at what's causing all of this inflation, again, there's one item that's not quite like the others. We have food, services, all items that are inflating to some extent. Then we have the energy prices. It's multiples above anything else. Now, as inflation is out of control and gas prices are at all-time high, our leaders on this subject seem completely incompetent. We have the Treasury Secretary, Janet Yellen, saying that she was wrong on inflation and she didn't fully understand the issues. She didn't understand the issues, and she's our Treasury Secretary. And then we have a White House spokesman going on CNBC and getting called out by Jim Cramer, of all people, for the president not being willing to work with oil companies. So the gas price issue is getting further and further out of control. And if you think that gas prices are just an isolated thing that only affects some companies and some parts of the economy, you're wrong. It bleeds into every single part of this economy. So we're going to be looking at the inflation report, but I also want to give an update on one of my holdings, which is VICI. I came out with a controversial episode where I actually made a trade. I did something that I don't usually do. I trimmed $15,000 of VICI after a rapid multiple expansion run over the past month at a share price of around $33 a share. Now, since then, just over the past couple of days, the stock price is down 7.6%. So I want to give an update on what I'm doing with VICI. So as always, we have a lot to get to in this episode. Let's go ahead and jump right in. We'll start off with the headline news. Inflation hit 8.6%. This was above expectations. It was expected to come in at 8.3%. Inflation is the measurement of price changes on a year-over-year basis, and what they do is they look at all the major components of it and they try to give it a weighting. Overall, it's kind of a complicated system that's not perfect, but we can look at the major contributors to inflation. May's increase was driven in part by the sharp rises in prices of energy. That's your gas price, which rose 34.6% from a year earlier, and groceries, which jumped 11.9%, the biggest increase since 1979. So two of the major contributors are things that people use on a daily basis. They use gas, which is energy prices going up 34.6%, and of course we have to have our groceries, which rose 11.9%. But overall, the biggest problem here seems to be gas. The national average gas price is nearly $5 per gallon, and just a year ago it was $3 per gallon, and we used to believe that this was pretty pricey. This is at a price we didn't like, but now it's up $2 per gallon. And when we look at the chart of what's really moving up in price, energy is the big standout. And this is a huge problem for inflation going forward. Because like I've mentioned before, energy is not some isolated thing that you only pay for at the gas pump. Even if you drive a Tesla and you don't even have to fill up with gas, you're still paying for these high energy prices. High commodity prices will flow through to higher core inflation with a bit of a lag. Companies initially try to take the hit, but after a while, companies will no longer want to absorb all the gas prices. They can't do that while maintaining their margins. So they start to slowly pass that cost off to the consumer. We can see this phenomenon illustrated in this chart. The headline CPI goes up first, and then the core CPI typically follows. Almost every single time, that's what happens. So even though energy prices may not be included as part of the core CPI, it'll eventually bleed into the core CPI by companies passing it off to the consumer. An anecdotal example of this is Amazon. When gas prices started to go up, Amazon initially did not pass the prices on to the consumer. They took the hit. And they're assuming in 2022 the incremental rise in gas prices will cost Amazon around $10 billion of EBITDA. That is a lot of money even for Amazon. And they're not going to take that hit forever. Eventually that will be passed on to the consumer. And that's exactly what they started to do. Amazon's new fuel and inflation surcharge may make many products more expensive. So even if you buy a Tesla, you're not going to the gas tank. If you're just buying things on Amazon, you're paying for higher gas prices. Rapidly increasing fuel prices flow into every other part of the economy. It's unavoidable. And this is where the Fed comes into play. In this article, they highlight once again that it's the Fed's responsibility to calm inflation by tightening monetary policy, meaning that they're going to raise interest rates enough to calm this inflation while also trying to avoid a recession. Because that is part of the Fed's dual mandate, to have stable pricing, which 8.6% inflation is not stable pricing, but to also avoid a recession, which means we have low unemployment. And the Fed is supposed to tackle both of these issues without any of the tools to do so. The Fed can raise interest rates. That is their primary tool for dealing with inflation, but interest rates is a blunt tool. It just slows down the entire economy indiscriminate of any specific part. And the truth is, the issues the Fed faces right now are things they can't solve. China's zero COVID policy causing supply chain disruptions. Does raising interest rates affect China's policy on COVID at all? No, it has zero effect on it. The war in Ukraine causing commodity prices to rise. Does the Fed raising interest rates solve the war in Ukraine? Of course not. Oil companies having low production, high margins, straining supply. The Fed can't solve that either with interest rates, nor can they solve supply and logistic problems caused by unpredictable demand. Inflation is being caused by numerous factors entirely out of the Fed's control, but they're still going to use their blunt tool, which is interest rates, to broadly slow the economy. And just today, one of the White House spokesperson went on CNBC explaining the inflation issue and all the efforts the president's doing to try to resolve it. And this is where Jim Cramer actually calls him out for one big thing the president isn't trying to do.
Well, Brian, look, you're a realist, and I appreciate that. We have to go brown to green first. The great Larry Fink, who I really love, has really outlined a path. And you know what? You haven't done it. You haven't just said, okay, listen, guys in the Permian, oil's at 120. We know that you're returning a lot of money to your shareholders. We need you to do what's right. In return, we know you need pipe. We know that natural gas would come down dramatically if they had enough pipe. I love your number, but your number's about the amount of pipe. Even if we just decide that we can keep the price of oil down by actually exporting it and get oil down in the future, you know, it's a win for you. But what are you afraid of? Are you afraid of being seen with guys who are involved with fossil fuel? Are you afraid of the president going to Permian rather than Saudi Arabia? Come on, man.
And Jim Cramer is probably right on this subject. The president doesn't want to be seen working with oil companies. And as there's not much being done to solve these issues, the issues continue to spread. Quote, given everything from the implications of the Russian invasion of Ukraine, the Chinese lockdowns, and just the sheer appetite for travel, what we've seen is the perfect storm of those factors hitting along with some major refinery closures. So oil companies have been closing refineries as the demand for gas has risen dramatically. Consumers' grocery bills have risen by an annual rate of more than 10% since early this year, a pace not seen since the 1980s. And every single grocery category measured in the report rose in May from a year ago. Every single one, most of them by double digits. And now there's numerous causes, unlike earlier in the pandemic when meat prices drove much of the increase. So in summary, inflation is well above expectations. Even though it's primarily being driven by oil prices, it's spread to multiple factors causing it now. The Fed really doesn't have the tools or the equipment to deal with inflation, and the experts are now suggesting that it's going to run higher in the future, not lower. This has caused the 10-year Treasury to now move up above 3.17%, where just earlier this year it was half this rate. So the 10-year Treasury is moving up rapidly, causing most other risk-on financial assets to move down in price. So this isn't positive news, but I actually want to share a positive view on this. And the positive news that I want to share, as everyone's giving these doom and gloom predictions, is that usually everyone's wrong. That's the positive news. Most everyone's wrong most of the time. And I have evidence of this. I can prove this. In fact, Let's go ahead and look 2 years back. Let's rewind a couple years and I'll give some examples. We have Ray Dalio. This is a legendary investor. He manages the biggest hedge fund in the world, which is Bridgewater. He has numerous economists working for him. The date is January 21st, 2020. And this gathering in Davos is where Ray Dalio shares his biggest piece of advice. This made headlines.
You can't jump into cash. Cash is trash.
Now, of course, we know what happened just a couple weeks later. In fact, a few days later, the US stock market fell 32%. In fact, Ray Dalio's comments that cash is trash almost perfectly timed the top of the market. Now, the S&P hit a bottom March 20th of 2020, and in the following 10 days, it moved up 8.47%. This was the first sign of a recovery in the S&P 500. March 27th, 2020, the S&P 500 was trading at $253 a share. This is one of the lowest points in this sell-off. On this day, Mohammed El-Erian, who is an economic advisor and an economist, called into CNBC to give his knowledge, his experience, and his advice on the subject. And after being asked if we're in the all clear, if it's time to be invested in the market after this substantial sell-off, this is his advice.
Let's put the question in very sort of blunt terms. Do you buy the index or do you selectively operate with individual names? If you feel it's the all clear, go out and buy the index. In fact, buy all indices because some of them have been beaten up much more than ours. I don't think we're there yet.
His advice is that we're not in an all clear. Investors probably shouldn't be buying the index, and they should instead be very cautious and selective. The following 2 weeks, the S&P 500 went up 13%, almost with no volatility. It just went straight up, and it kept climbing. In fact, it climbed rapidly. In early June, investors' attitudes had totally switched from being bearish and scared to being overly bullish. The Fed was saving the market, people were being given stimulus, and it was time to buy stocks. And there's quite possibly no person that epitomized the attitude of the entire stock market better than Dave Portnoy.
Everything's going up. Stocks only go up. This is the easiest game I've ever been a part of. You buy your planes, you buy your trains, you buy your automobiles, you buy your casinos, and you're rich. You're rich. You're Scrooge McDuck rich. Boeing's up 5%. Spirit is up 17% after being up 17% yesterday. Penn's up 2%. Norwegian's up 1.5%. Guys, winners, 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 chicken dinners. My stocks are like the best, I guess is the word I'm looking for. My stocks are the best. Is that what we're talking about? I have the best. Listen, I have the best stocks. Warren Buffett has the worst. I have the best. How do you like that?
And that was not the last time that he compared himself to Warren Buffett. And in fact, at that time, Warren Buffett was being mocked by many investors. He was considered to be old news. He was underperforming the S&P 500. He was invested in these old, antiquated companies that were focused on profits and cash flows. He wasn't investing in artificial intelligence and robotics. Warren Buffett, for the time being, was an old, antiquated investor that was underperforming the market. And we had a new hero emerge, a newer, more exciting, more forward-thinking, more innovative investor, Cathie Wood. In June of 2020, investors became very excited about the ARK Invest ETF. The performance of it was outstanding. There's almost no price too high to pay. The stocks in this ETF just went up and up and up every single day. And so did the assets under management. In fact, in July, they went from just being at $1 billion in assets under management, growing all the way to $17 billion. Now, despite some people's best efforts to give warnings that valuations are stretched and future expected returns are very low, investors in February of 2021 were as enthusiastic as ever. And nobody at this time was more enthusiastic than the leader herself, Cathie Wood. She, in fact, called her stocks deep value.
But there's also a reason, an investment reason we are moving into them. Ironically, we think they're deep value names because...
She described her portfolio of companies as deep value February 17th, 2021. This happened to be 5 days from the absolute peak of ARK Invest. And within 20 days, those stocks fell 24%. Now, again, at the time, I have to remind you that Cathie Wood was looked at favorably by almost every investor. Going against her was something that was controversial. We have comments on this very video from a year ago. It's so refreshing to hear her talk about the future. This had 171 upvotes. Another commenter says, "This clever lady made me a lot of money this past year. Thanks for the gains, Cathie. Keep up the good work. I like her more every time I listen to her. She sounds very honest and thoughtful." And then there's a lot of comments to the extent, "In Cathie we trust." People put their money with her and their trust with her. Now, all of that praise and trust for Cathie Wood was tested when the following 2 weeks, the ARK Invest ETF fell 24%. and then continued to trail off all throughout 2021 and even further into 2022. At the time, the S&P 500, which up until that point hadn't been performing as well, started to make some grounds on the ARK Innovation ETF. It was actually going further and further into the green all throughout 2021. And this is where we get Ray Dalio's advice again. He's once again asked about his position in cash and if investors should be raising a cash position, because at the time it seemed like the market was getting a little bit ahead of itself. Valuations were starting to get stretched again. This is Ray Dalio's advice for the second time.
I've been quoted, cash is trash. Cash, which most investors think is the safest investment, is, I think, the worst investment. And so cash, like this year, you'll lose 4 or 5% to inflation. And so pay attention to those, because I believe that that'll be the worst investment.
December of 2021, Ray Dalio was cited again, saying that cash is trash, it loses buying power to inflation, and he thinks it's going to be amongst the worst investment. And that interview on December 17th of 2021 was again timed at almost the top of the market. Now, of course, after the market has entered into a bear market, Ray Dalio has updated his advice to saying, cash is still trash, but stocks are even trashier. He left out that last part in the earlier interview. Now, I don't just want to pick on them. We have other market forecasters. Tom Lee, one of my favorite here, who has ultimately been bullish on the market over a long period of time, was again bullish on the market February of 2022. Listen to his advice here.
Institutional investors are cautious. Retail basically priced in a bear market, and their sentiment's the worst in 8 years. You could have a huge rally. And as we've written before, recoveries from a fast sell-offs actually typically are symmetric, meaning you should expect a violent rally.
His forecast is that we would have a violent rally in February. Now, February was a violent month, but unfortunately it wasn't a rally. Now, I don't pick on all these people's calls just to criticize them. Ray Dalio, Cathie Wood, Mohamed El-Erian, Tom Lee, they're all very intelligent and extremely successful people, which I think is more evidence that no matter how smart or intelligent or educated, no matter how many titles you have, trying to predict the future of the market on any consistent basis is near impossible. Now, there's one other piece of evidence I want to share that illustrates how impossible it is to predict the stock market. But before we jump into that, I have to mention today's sponsor. That's right, we finally have a sponsorship for the Joseph Carlson Show. We're all grown up. And I'm sure you've heard of this sponsor. They're called FTX US. They're one of the world's largest US regulated cryptocurrency exchanges. They have millions of people using their services on a daily basis. They have promotional deals with a lot of people you probably heard of, like Kevin O'Leary, Steph Curry, Tom Brady. And the company's a well-backed company, with the founder of it being only 30 years old, having a net worth of over $10 billion. Now, FTX is commonly known as the cryptocurrency exchange, and I don't own any cryptocurrency. I don't own any Bitcoin or Dogecoin or anything like that. And I don't really plan on buying any cryptocurrencies in the future. What a lot of people aren't aware of is that FTX is becoming more than just a cryptocurrency platform. They're expanding into other fintech categories like stock trading. They have a new tab on their website called Stocks, which is currently in beta right now, and I'm working on building up a little position in Amazon. Right now, I currently only have 3 shares. And if you want to follow along with this, you can do so completely free. It takes 2 minutes to sign up. I put a link in the description and the pinned comments of this video. And when you sign up, make sure to use the refer code Carlson, my last name. That lets FTX know that I sent you, and they also credit your account $10 once you fund to 100. So you can sign up for this at any point now, and the stock portion of FTX should be released out of beta in a couple of weeks. Now back to the video. The last piece of evidence I wanted to bring up of how difficult it is to predict the future of the economy is data gathered from a Twitter user called QCap. What he did was pretty interesting. He dug up old covers of The Economist year by year, and he aligned them with the performance of the S&P 500. And this is pretty telling over time. For example, the cover of The Economist in April of 2004 was titled "The End of Cheap Money." That sounds like a pretty bad thing. The end of cheap money, interest rates going up. The S&P 500's performance in 2004 was 10.74%. The 2006 cover looks a little bit relatable to now. It says, "Don't mess with Russia," and it has a picture of Putin holding a gas nozzle. The S&P 500 still returned 15.6% that year. In 2007, The Economist had the title, "The Trouble with the Housing Market." It finished up 5.48% in 2007. Now, in 2008, the cover did look gloomy as well, and this time it was actually warranted. The Economist said that it was a world on the edge, and the S&P 500 finished the year down 36.5%. In 2009, the cover didn't look any better. It has debt, the biggest bill in history. And this is a year that the S&P 500 finished up 26%. In 2010, there was warnings of bubbles and massive overvaluation in assets. Stock market finished up 15%. 2011, there was nowhere to hide, investing during times of crisis. The stock market finished in the positive by 2%. In 2013, it was the perils of falling inflation, and the stock market finished up 32%. In 2016, it was Trump's triumph, an American tragedy, and the stock market finished up 12%. In 2017, The Economist had covers talking about the possibility of nuclear wars with North Korea, and the stock market finished up 21.8%. 2020 has one of the most bleak covers, the world with a closed sign on it. The stock market finished up 18.4%. 2021 doesn't look any better. We have the shortage economy, with the stock market up 30.9% over the year. And then this year, we have one denoting the Russian-Ukraine war, with the S&P 500 down 17%. The point here is that you could have seen all of these headlines, all of these covers in advance for every given year, and you still would have had no clue of what direction the stock market would have traded on a given year. Some of the most bleak headlines and bleak covers are some of the best years, and some of the most mundane headlines are some of the worst years in the market. Having economic insights and predictions of the future, even if true in many cases, don't help you become a better investor. So my focus is remaining the same. I'm focusing on buying high quality dividend paying assets that produce a lot of cash flow. I think they have wide economic moats, and I think these companies will grow over a long period of time. I have no control over inflation or how gas prices will play out in the future, but I do have control over my portfolio and my investments. Now, one of those investments is a real estate company called VICI. The stock was trading around $33 a share June 6, and I decided to trim the position by $15,000 because of the sudden multiple expansion in the stock. I thought there's a very strong possibility the multiples on the company would revert closer to the mean. Now, over the past week, it's done just that. Just from the sale point, it's down around 8%, and I've started to dollar cost back into this holding. I've also been buying other dividend paying companies. Even though it looks like we're going into a recession, I did increase my stake in JP Morgan. I think even if we go into a recession and there's an economic slowdown, I think that JP Morgan will survive. This isn't like 2009. The banks aren't over leveraged, and JP Morgan has a very strong balance sheet. So I think this company will survive a recession and continue to pay its dividend. I also invested a little bit more into T. Rowe Price as the valuation has come down substantially. And then another company that I bought more of for the first time in a long time is Target. I bought another $1,000 worth of Target for the first time in 3 years. So even though the stock market's falling, I still view this as an opportunity to buy good dividend paying companies at higher yields and lower valuations. And I think for the long-term investor, this will prove, like many times throughout history, to be a temporary issue. So I know this year's been a struggle, but I still feel positive about things going forward. Now, there's my thoughts for today. I hope you enjoyed it. If you like this type of content, make sure to subscribe to the channel. You can check out the Patreon. It comes with a free trial. It gives you access to Qualtrim.com as well. And other than that, I'll see you in the next one.